When I joined a venture firm in 1997, and I spent quite a few years in venture, we funded pretty much no women. I think for your listeners, like, you don't actually realize how much things have changed.
This is Funded, a show where founders who raise millions in venture capital share the gritty side of what it actually took to get that money in the bank. I'm Jason Ye. Not too long ago, I was trying to get my ideas funded. And back in the day, I was a VC listening to founders pitch me for money. Over the last 20 years, the startup and venture capital ecosystems have evolved in many ways. We've seen hot industries explode like mobile, SaaS, crypto, and AI. And we've seen the landscape of capital change from the emergence of mega crossover funds to the rise of angel investors and solo GPs. One important trend that we've seen over the same time period has been in the increased representation of female founders. Since 2009, the percentage of founding teams that include at least one woman has more than doubled. And while there's still tons of work to be done, we are seeing progress. Today, I get to talk to a founder who's experienced all of these trends firsthand. She started off her career as one of the only venture capitalists in the industry that was a woman, before becoming one of the few female founders receiving venture capital dollars in 2013 for her first company. All the way till now, having landed a full $39 million for her current company, Midi Health. My guest today is Joanna Strober, and if you couldn't already tell, she's pretty impressive. After hearing about her crazy background, I was extremely curious to hear if there was anything in her childhood that led her to become the trailblazer she is today.
I was a pretty studious kid, that I had a very happy upbringing. I mean, seriously, I don't think there's a better place to grow up than Palo Alto, California in the 1970s and 80s. All my friends' parents were professors at Stanford or were engineers here in Silicon Valley. I just went to high school, honestly, with the most amazing people. I was just surrounded by a lot of really smart people, I would say. A lot of smart, ambitious, geeky kids, basically.
Yeah.
That was the norm around here. But I also didn't have any role models of women at all, honestly. So, I mean, the women, very few of the moms I knew of my friends worked.
Okay.
They certainly were not raising money to start companies. They were not, if they did work, they may have been, probably a few may have been professors, but it was definitely not a model of working moms that I saw. And my mom is an amazing, amazing mom, but she was also a stay-at-home mom. So the models that I saw were not that, and certainly not entrepreneurs. So the other models, even honestly, I went to Penn for college. I went to law school. I started working as a lawyer here in Silicon Valley. There were no female partners at the law firm that I worked at, none. Wow. Actually, I take that back. There was one. She cried every night, and she quit.
Gosh.
So the models, and also I was working with venture-backed companies, none of whom those had female founders. So I want to talk about that, because it's not so much what I saw, but what I didn't see. And I didn't see anyone like me raising money. And when I joined a venture firm in 1997, and I spent quite a few years in venture, we funded pretty much no women. So none. Wow. I went back and looked in preparation for this discussion, and I tried to see which women we funded in those years. I cannot find them. So, I think for your listeners, you don't actually realize how much things have changed until you really look back.
Yeah. No, it's an incredible background and a great way to start this conversation. First of all, understanding, the bookishness and where you came from, and then also not having those entrepreneurial role models, I think overall maybe, but certainly from the female perspective. But you touched on a few things, which is kind of maybe where I want to accelerate the conversation. You weren't thinking about being an entrepreneur. You went to law school. But then you do get into venture capital, which gives you a lot of the perspective of what it means to be a founder overall, but a venture-backed founder. You know a lot about fundraising, or at least from your side of the table, enough to be dangerous. But what we get back to is this idea that you never saw anyone else do it that looked like you, or very few, if any. So, this is unlike what I would normally do, but do you remember being in the seat of a venture capitalist? This is probably years before you went into being a founder yourself. But even with all that back knowledge, you kind of must be thinking to yourself, like, do I have what it takes? Or do you have a chip on your shoulder that says, like, I definitely can do this, even though no one else could do it? Do you remember your mindset back then?
Mindset when I was 20 something, or mindset more recently?
No. Now I actually want to think about, because you at some point made the leap from venture capitalist to, and a corporate worker, a lawyer, to then actually starting a company. But that leap, even with all your background, must have been a bit harrowing, because you're like, can I do this? Or why aren't other people that look like me doing this?
So I've had 5 careers, at least.
Okay.
Honestly, I've had a lot of different things that I've done in my life.
Yeah.
I did venture investing. I worked in a fund of funds. I started another company before this one. So I've done a lot of different things, and I think all of them were in that same position of like, well, why shouldn't I be able to do this? But it's really helpful to see other people. And it is hard when you think you're the first one, and when you don't see other people around you who are doing these things, it's much harder to envision yourself doing it.
Got it.
So I think, I think that the more that you see other people who seem like you doing it, it just seems easier.
Totally. Well, so you've been a trailblazer throughout your career. You're on your maybe 5th or more careers, and I'm sure you'll have different ones from here on out. But at some point, I'll touch on what we said, or what you had mentioned, which was you had started another company before Midi, and actually, from just looking it up, seemed quite successful, raised real venture capital dollars, almost $6 million, and then actually led it to a sale, right? So we don't have to talk about that experience. And my thought was that I wanted us to then fast forward to starting your next company, because like in our side conversation before we jumped into this, we talked about this idea of showing different stories to founders who might be listening, to get inspiration, to see themselves in the founders who we cover here. Your setup for this company and this most recent fundraise is that of someone who, by that point, certainly had a great background in network. You had been a venture capitalist. You'd been at a fund of funds, which I didn't realize. Lots of connections there. And the craziest, best part about it all was that you had actually run a company successfully and made money for your investors. I mean, as a former venture capitalist, that's like check, 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 check. So crazy ability to then go into deciding that you wanted to do your next company. When you started Midi and you were thinking about Midi, did you know right off the bat, like, okay, this is a large venture-backed company. We're going to need to raise money for that. Was that the mindset
Yes.
going into it? Okay.
Yes.
So you wanted to go raise your first round of capital, and this is a story we haven't told, and this is certainly funner, more comfortable than maybe when you went out to raise your first round of capital for your first company. But going out to say, we want to raise money to start Midi. Can you tell us what that was like? What is it like being a founder with a successful exit who wants to go raise? What was your process thinking about how you'd raise capital for this company? The first round.
So I'm going to tell you, right? You think from reading the press that, oh, you're a second-time fund person, it should be easy. Maybe it's easy for some people, but it was not easy for me. It was not like, oh yeah, people are going to throw money at me at a good price. Just to be clear.
Can I pause you there, Joanna? And because I do want you to finish this thought, but I loved that you shared that, because so many people, when they're looking up at the headlines, they're like, oh, I'm not them. Or like, it's easy for her. It's easy for him. They had all these things. And I think that's right. I think you would be super surprised at how hard it is almost every single time. So anyways, I'm so glad you shared that. Tell us more.
Yeah, it's honestly, I was just giving a talk yesterday at one of our funders, a party they were having for entrepreneurs, and now they look really smart investing in us. At the time, it didn't feel like it was that smart. Like, it looked really risky. Who knew whether women were going to go trying to get their care online, and whether this could scale, and what our CAC would be, and could we get insurance coverage? There were so many questions when we first started. And so it was not a no-brainer investment. I'm super grateful to those people who did that first check, and it was not a no-brainer. So any idea that just because it was a second time everyone would trust me was not the case.
You're like, shouldn't they trust me at this point? Finally, can this be easy? Okay, so there was still real work that went into this. I looked at the reports on Crunchbase of when at least the funding was announced, and there's always some bit of lag. So my guess is that that first round, especially with how large of a round that seed round was still done with a decent market in place. Like the funding market was still quite active. Am I right around when you raised the seed round?
So yeah, but actually that funding announcement, let's be real, that funding announcement was actually like 4 different rounds of funding that were all just rolled into one. So, right, we raised earlier, we raised a few million, and we raised more like that. We just didn't announce it.
I see.
So people understand, like, just because you see a big number like that, it doesn't mean that it was all raised at that one time. Also, yes, it was a good funding market, and it was still really hard. I think you just because it was a good funding market, some people, you're right, some people can go raise a huge amount of money at a really high price, and that was not us.
Okay. So I'm glad you pointed that out. And just for everyone following along, what I was reacting to was on Crunchbase, it says that a $14 million seed round was raised and announced on October 27th. And what you're clarifying for us is that that was chopped up a little bit. And then when you announced, you just announced it all at once. The thing that I want to play into or sort of pull apart here is, if that were chopped up, that means you did raise some in the hottest market possible. Like in the hardest market we've ever seen in venture capital, certainly in my career, probably in your career as well. And what a lot of people don't realize is that at the time, everyone was looking to their left and right. I remember I had recently exited my last company, and people were like, should you raise money for your next company? Should you raise a venture round? All this money was going around, and people felt like, oh, all the people that are raising now are so lucky, and they're doing it at the right time. But what we've come to learn is that because it was the hottest market, that a lot of times these companies were raising capital at super high valuations relative to traction, which leads me to actually where I want to focus our conversation, which is the most recent impressive round that you announced. And my point is, and you can clarify and you can share what you're comfortable sharing, is that going into this last fundraise, which was announced in September, $25 million led by Google Ventures, you were likely sitting at a pretty high valuation and in a really bad market. I mean, this is just reading the tea leaves. I could be wrong, but this is kind of where I wanted to jump in and hear a little bit about what this round was like. What were you thinking? What was going through your head? What triggered the need to raise? And then any stories that you can share about, what it was actually like. So I'll pause right there and just say, like, was I slightly accurate? Was I well off? Let's go from there.
So I think you usually talk to different founders than me, honestly. No, I was not coming into it with a high valuation. I had a very low valuation every time. We did not have any high valuations.
Amazing.
So now it might look
you had given the advice before of don't just raise at the highest valuation. So when you went into it, I mean, tell us a little bit more about that.
No, but honestly, it wasn't necessarily my choice either. Right? I raised it at valuations that I was able to get. That's what I was able to get. And I really wanted to build this company into a big company. So I was willing to take valuations that some people, if they were coming out of Y Combinator, might have said were too low. But I wanted to raise the money for the company and was willing to take those valuations to grow the company. So now it looks like we got lucky because our valuation is not super high, so we don't have to worry about down rounds or recapitalizations or anything else. But
That's
it's not luck.
Well, I've seen this happen before too, where founders during the hottest market, and I won't even say, what gender or race they were or whatever, but they were getting lower valuations, and I remember them being upset about like why this was happening. And now when we look back on it, we are like, oh my gosh, like that might have been the best thing that ever happened to the company, that you could take a reasonable valuation and continue reasonably growing and get to your next round and be like, yeah, we still have the right momentum. So, okay, that's where you started. So as you went to go raise,
round, we had an opportunity to do an up round, right? Like we didn't have to worry about doing a down round. We didn't have to worry about disappointing our investors. We did get 2 term sheets at low valuations that we thought were too low. And they were trying to take advantage of the new market. And they said, well, this is a new market, so you don't need to get an up round, basically, or you don't need much of an up round. And we were able to be much more successful than they assumed. I think that investors were thinking they could get a discount for the market, but we were showing really good traction, so we were able to be more successful than that.
As markets get tough, so do investors. Even for founders like Joanna, who had the traction to prove that her company was great, still had trouble convincing investors that it was going to stay that way. After the break, we get to hear more about Midi Health's Series A, as well as what it was like for Joanna to go out to raise again. A lot of people assume that once you've done it once, it gets easier. But does it? Like many of you, my last venture-backed startup was a SaaS business. In that company early on, we had the opportunity to sell into a large enterprise, but ran into some walls when they asked us if we were SOC 2 certified. Not only were we not certified, we also found out that it would take our small team a ton of time to get that done, and so we ended up abandoning the deal. If you haven't run into a situation like that where a potential customer or investor is asking if you're SOC 2, HIPAA, GDPR, or ISO 27001 certified, you probably will soon. But unlike me, you could use a company called Vanta to help. Vanta helps automate up to 90% of the compliance work, getting you audit ready in weeks rather than months, and eliminating up to 85% of the costs. Not only that, but Vanta can start small with you and scale up as you grow, helping you land bigger deals and earn customer trust. The best part is, Vanta is offering funded listeners $1,000 off for going to vanta.com/funded. That's VANTA.com/funded for $1,000 off your service. Check it out. So let's double click into kicking off this latest fundraise. So you announced in September. I assume you were going out at the beginning of the year. But can you tell us a little bit about what was happening in the company and what the trigger point to saying, I think we need to go start fundraising was? Was it hitting a milestone? Was it the amount of runway you had left? Was it a combination of a few things? Tell us a little bit about that.
Yeah, it was really both. It was both the fact that everyone was saying, well, you need to start fundraising a year in advance because the market has changed, so make sure you give yourself a year. And we were having really good traction, so it also seemed like a good time to fundraise. So it was really both of those. It was both those things coming together.
Okay. And how do you feel about going into fundraisings now? This is, I don't know, number 7 or 8 rounds that you've raised across a few companies. Have you grown like a sense of like crazy confidence about it, or is it still like nerve-wracking to you?
Zero crazy confidence. That is not how I think of this with crazy confidence. I mean, I'm going to have to go do it again because we're growing really fast, which means more money is required to support the growth that we have right now. And so I am thinking about starting again to go raise more money, which seems crazy that we would have to go raise more money, but we are way ahead of our plan on everything we told them. So now we have to go do it again. Yeah. And I cannot tell you that there's any crazy confidence. It's like, okay, how do I tell the right story? How do I write the right deck? How do I convince people of what I am seeing? I know what I'm seeing, but convincing other people of that and why it's such a big opportunity is a challenge, and every time.
Yeah, I think what founders don't realize, or people from the outside don't realize, is like anything that is like on paper a slam dunk might not actually create that outsized return for people. So it is like a crazy story that you're always having to tell, and there's going to be people that don't agree with it, and you kind of know that yourself. So it's like getting ready to be rejected a bunch. I guess never feels better, right? So can you tell me a little bit about how many investors you thought you would have to talk to, like as you started preparing for the fundraise, where you're like, we're doing it a year in advance, we know it's going to take a long time? Did you feel like it had to be a bigger number? Like, how did you think about your fundraising strategy?
Actually, I think the thing that we did really well is we spent a lot of time cultivating investors from the first fundraise who said no, and keeping them up to date on how we were doing and kind of bringing them along with our story. So by the time we needed to fundraise, people knew what we were doing, and they saw that we were outperforming on our numbers, and we told people in the seed, here's what we're going to do, and we were doing better than that on every metric, and we were constantly updating people who we thought we wanted to invest, including the Google Ventures people. So it was actually a very easy fundraise, because we were able to go to people who we had been talking to for quite a while and say, okay, we're going to start fundraising. Here are our numbers. We told you we were going to do this. We did X plus this. And it was a much less painful process than you may have thought.
Right. And so that's another thing that's great for people to hear. It's like founders, especially ones that maybe didn't come from the industry or are a first-time founder, they get discouraged by the fact that they see other people do it quickly, do it fairly easily, and then feel like, oh, we should be able to do that. So like, let's just go out and talk to investors. And I think like, it sounds like most, if not all, of the investors that you even talked to for this round that by any measure was extremely successful were people that you had been talking to for over a year, right? Like,
and they turned me down before.
And they turned you down before. So Google Ventures turned you down before?
Yeah.
That's great. That feels amazing. So I think like just even hearing that, like the reason it went so well was they had perspective on who you were, Joanna, and what Midi was, and your ability to continue executing. And whether it's around like your Series A after a seed, or you're going out to raise a pre-seed, if an investor has like data points on you from before, something that they can match against and say like, does this founder have the ability to execute on it? That's what makes it easier for investors to do deals. And so I think hearing that is probably a bit of a wake up call for some people, and like what is necessary in order to get an easy round done. And if you don't have those relationships in play, the reason it takes a long time a lot of the times is because they do need to get to know you. They do need to develop conviction around you and the business. So very, very cool to hear. I'm glad that this one was a little bit more comfortable. Still
a lot of people turn me down.
Before our interview ended, I asked Joanna if she'd be willing to share the worst experience she could remember while fundraising. Seriously, I can't believe that some of these things actually happen.
So in 2014, I raised money for my first company, Curbo, and the best, most memorable one was when the person said, well, I already have a female in my CEO this year, as a female CEO this year.
Oh, God. Wow. It's like it's almost like you made that up, like this is a sitcom.
Yeah, that one I remember. I left, I was like, oh, okay. The world has gotten much better. So actually this time I would say I didn't have any horror stories. People were incredibly nice. They were incredibly respectful. I really felt
even
very
in this
fortunate.
market.
Even in this
It's
market.
great.
I think they didn't all say yes, lots of no's, but it was very respectful no's, if that's, and I appreciated that. And I felt like this time I got a very fair hearing from people. They may have said, I don't believe your margins. I don't believe you're going to grow this fast. I don't believe, blah, blah, blah. But it was just how you would have wanted to be treated, honestly, in the sense that people either were going to believe your story and buy into it and then want to know more details, or they didn't believe the story, which was fine too. But I felt very respected during the process.
That's awesome. There's a speech that I give to founders because a lot of times we'll do workshops, and the makeup of those of the audience tends to be, and not by design, but tends to be pretty diverse background, a lot of women. And one of the things I talk about is the fact that I still have tons of connections in venture capital, and we talk a lot about their desire to change. And it's like, actually, because I've been on both sides of the table, I'm very pro founder, but I also understand venture capitalists. I don't vilify them. I think most of the stuff that happens is not malicious, right? And I've talked to these VCs, and they're like, we are actively trying to make sure that we look at all types of deals, that we look at all types of founders. And but the usually harsh reality that I do share with founders is that they are still using inaccurate tools in order to make decisions. They still use pattern matching as the thing that allows them to make quicker decisions. And if most of the deals they've done in the past have been done by men, like even if they're not explicitly biased, there is some implicit bias there. And so usually what I tell people is, look, the industry wants to change. It does, and it's trying to change, but it's trying to move a very big ship, like you're kind of moving it like this. And one, Joanna, I'd just love to say, awesome that you experienced, just what you said, the way you would want to be treated. And then two, what I tell founders is like, you may be the pattern that other people get to match against in the future. And it sounds like that's what you're doing, Joanna, which is incredible. I think this is a really great story. I do like just asking. So you now have been a venture capitalist. You've run a couple companies, and you're in Silicon. You grew up in Silicon Valley. You live in Silicon Valley now. We always love hearing about the sort of next generation of founders that are coming up. Do any founders come in mind? Maybe founders that are just getting off the ground that we should keep an eye on, either their names or their companies. This is like a fun little segment that we'll put out sometimes.
Yeah, I'm blown away by all these young people that I meet who are starting great companies. I mean, I am old in the sense that, I've been doing it around for a long time, and not super old, but I'm just blown away by these young people who are starting great companies, particularly in healthcare, because that's where I'm focused. But I find it incredibly inspiring, all the young people I meet who are starting really cool healthcare companies to solve serious problems. And they inspire me a lot, actually.
It's amazing. That was my conversation with Joanna Strober, founder and CEO of Midi Health, expert care for women over 40. And while the VC industry could use a lot more improvement, it's safe to say that trailblazers like Joanna have driven a lot of change, and that makes me excited for the future. When we come back, I get to talk to my producer, Paige, to hear her thoughts and questions about today's interview. Okay, so I've actually struggled with focus my entire life, which might be surprising to some people because I got good grades, went to good schools, got good jobs. But really, I was able to get that far in spite of myself. It's been a struggle all my life, and that struggle really came to a head once I became an entrepreneur. At that point, there was too much going on. I couldn't overpower my lack of focus. So I tried a bunch of things, planning apps, coaching, but nothing really made a dent. And then I started hearing about this special productivity drink, Magic Mind, and was super skeptical. Honestly, it wasn't until a friend gifted me some that I became a believer. When you take a little bit of this stuff, it's hard to describe, but there's like this feeling of focus that just washes over you, where all of the things that normally distract you no longer do. And honestly, it's been a game changer for me. So I'm really excited because Magic Mind is sponsoring this podcast and offering up to 50% off your subscription if you sign up within 10 days of this airing. All you have to do is go to magicmind.co/funded or use funded as your promo code when you're checking out. Hope you guys try it out and that you like it as much as I do.
Hello, Jason.
Hey P, what's going on?
I am just processing this episode, which had a lot of moving parts to it. And I feel like I always start off with saying, oh my God, this founder is so impressive, but it's so true. And I actually really extra mean it today because, like she said in the interview, she's had like 6 or 7 different careers. She's been, and not to mention doing this at a time where the careers she was doing was not common for women. She went to law school. She said she was one of the only law students there that was a female. She was a venture capitalist, said that she was one of the only females there, and also saw she couldn't even find a deal that she did with female founders. Then she's also she started another company, fundraised for it, sold that. Now she's on to her next one. I am awfully impressed with her. And maybe I can hear your thoughts. Yeah.
No, I mean, first of all, like she certainly hasn't chosen the easy path ever. It's like, it's much easier when other people have done it and, carved out the trail for you, but she definitely has been a trailblazer. And I know from experience being the first might be lucrative, but definitely not the easiest. And, the other thing to say is she really deeply understands this industry from all angles.
Yeah.
Being a venture capitalist, getting to be a partner at a big firm. And then I'm not sure she mentioned it, but she was at a fund of fund investor, which is essentially an investment firm that invests in venture capital firms. So she's been a venture capital firm that invests in startups. She's been in a fund that invests in venture capitalists. And then she's been a founder that's raised capital. And still with all that, like it's challenging, which I think is a good part of the story to tell to people.
Mm-hmm. And I wanted to point out, I literally wrote this down because I loved this quote so much. When she was she was talking about her career and all the careers she's had. She said, every time I wanted to do something, I just asked, well, why shouldn't I do it? And that is like the definition of a trailblazer, like you pointed out throughout the episode. And I also think it's cool because as she was speaking about all these different things, my mind kind of went to this topic of pattern recognition, which you speak about a lot. And just thinking about how it's people like Joanna that are the ones that are creating this new world of pattern recognition for female founders. Like you look at Joanna and her background and what she's been able to accomplish. And luckily, maybe for future female founders down the line, they'll be able to use Joanna and people like her to be like, yeah, they've done it before, because we know where we've been stuck in, which is something you've talked about for a while. So I don't know if you have any thoughts around that.
Yeah, totally. I think like talking a lot about what pattern recognition is, how it helps venture capitalists, how it holds certain founders back is a part of just learning how to navigate the ecosystem, whether or not you are a founder that fits a pattern or not. And so, I think it's worth saying the words that I usually share with people, which is like pattern recognition is one of the most well-used tools in a venture capitalist toolbox when making decisions. It's not 100% accurate, right? It's just, you can't say that because I am talking to Paige and Paige is a founder that looks like another founder that I've backed who's been successful. Now I want to back Paige. Like that is a very fuzzy match. It's fraught with mistakes. You can't just say because they feel the same, they're going to be the same. But I think what's important to call out for people is that VCs don't have many other, if any other, more accurate tools to use in evaluating founders, especially at the earliest stages. Like what founders really need to understand is that investors are making a bet on the future that nobody with any amount of experience or skills can tell with 100% certainty that it's going to happen. It's like, I talked to this founder, we're trying to say that in 10 years that this company is a massively profitable public business. But today we're at day one. Like, what are the things that we can use to try to do better at making that bet? And well, one of them is to just be like, well, this kind of looks like something I've seen before. And
Yeah.
so a lot of people can get upset that that is one of the tools that VCs use. But if you really start thinking about the way decisions are made and the data that's available to make these decisions, you might be a little bit more sympathetic that that's happening. Now,
Yeah.
where that falls apart or that doesn't help is when there are really great founders who have deep knowledge and expertise, hard-earned, unique insights in an industry, as well as, experience or real data points that say that they can execute. And all those things are there, but they just don't happen to look, sound, smell like a founder that the VC that they're talking to has seen before. That's when that model falls apart. And so,
Yeah.
we talk a lot about the things that founders that don't fit the stereotypical pattern can do to help with that. But one thing that we love seeing is when successful founders who don't look like the stereotypical norm start becoming more and more successful and start interacting with more and more investors, because like you said, they then become the pattern
Yeah.
that future founders can take advantage of. They can be, oh my God, Paige Randall, she just reminds me a lot of Joanna Strober. Like,
Yeah.
has that
I
same
wish.
energy, no, and I think you can say those things. And it's like, that's what Joanna is doing by being a trailblazer. So yeah, love that about her.
Yeah. And I also like kind of on the same topic, I wanted to bring up because Joanna was talking about how when she went out to raise for her second company, Midi Health, her current company, even though she had raised before, I don't know if it was the market's been a little more strung out, but she had a very hard time. And I found it interesting because her company before that was so successful. She had a successful exit. She had proved that she could reach the milestones that she said she was going to. And then that still wasn't really enough. Like she said it was actually very hard to go out and raise like the first few rounds for Midi Health. And I want to hear your thoughts on that because obviously everything has its own different variables, but I just feel like that'd be one of those things where it'd be like a jackpot for a VC. You find a founder who like you can be confident in their ability to go out and repeat what they've done before, but it wasn't the case for her.
Yeah. Look, I think you're right that there are a lot of confounding variables possibly with timing and market, whether or not, it was a good market or a bad market. This does feel like one of those situations that is an example of one of my sort of tough love speeches that I give to cohorts of founders, which is like, I do just think it's going to be harder for some people, right?
Ugh.
Like you have a pristine background, you have the experience, you've started and sold a company, you have metrics, and it does seem like those things lined up, pointing at a big industry and a big opportunity, should be a no-brainer for tons of people to line up to invest. And like, it's not saying like even the best and craziest fundraisers have people that don't want to do the deal, right? But in this situation, I have to believe that a lot of that difficulty for Joanna is because pattern recognition is harder with women and harder for VCs to just blindly get stoked about backing a female founder. And even saying it out loud actually makes me feel a little uncomfortable.
Yep.
That shouldn't be the case. Joanna has proven herself over and over again. That should be a profile that people line up to back and just be like,
yeah,
when is the next time that I can invest in you? Because when that is, like, don't even tell me the valuation. Just, let me send a check. That should be what it feels like. But hard to say without knowing all the details. But she got through it because, as she's proven throughout her career, she, why not her? She's going to do the work to get it done.
And she has got it done. Like she literally, one of my favorite parts that like when she was speaking about like leading up to this recent Series A, is all of her past raises, she had surpassed the milestones that they had set out to achieve. Like she had gone way beyond it. So it's like, all right, after a few rounds of you surpassing and doing so much more than you said you were going to do, it's about time that she had a semi easier round, which wasn't just because they were like, oh my God, Joanna is amazing. She was putting in the work before the Series A to constantly reach out to past investors and be like,
Yep.
hey, we're still doing more than we said we were
Yeah.
going to do.
We
Hey,
said we were going to
again.
do it, and we did it, you know?
And she kept saying it. And that's one of those things where obviously it sucks that she even has to do that. But now I really do believe like she is one of those people who is breaking the pattern, like for other women that are going to come up, because she's had to prove herself over and over and over again.
Right. And you bring up some strategy. It's not even a strategy. It's just something that people have to fall back on, which is like, well, you know, you might not follow pattern recognition by looking at what this looks like. And I'm motioning around my face, but I will show you a pattern that's going to be undeniable, which is my pattern of execution, showing you a goal that we've set out as a company and meeting that goal. And then showing another goal where we raise the bar and meeting that goal again. When we show you that pattern, it's going to be hard for any investor to say no to that, because it's like, well, I have seen that before. And it has nothing to do with what the founder looks like. But when I see this pattern of execution, that's something that I want to back. That's not as easy of a pattern to create for investors to see. But it is that higher bar that a lot of people will have to meet, which is just that execution pattern that you showed to the investment community, which is colorblind, to be honest, is gender and colorblind.
I did have a clarifying question that just came to my mind while we're on this subject. For her earlier rounds, I believe she had a lower valuation. She was talking about it like you asked her, oh, didn't you have a high valuation? She had a low valuation. And I'm just wondering, what is bad about having a lower valuation? Like, how does it not, like, I'm going to leave it at that.
This is a great question. And like, I can read it on your face. Like maybe you're like, I'm a little embarrassed to ask this question. I've been with you for a year doing this. Should I know this? And as I always tell you, it's like, if you have the question page, I bet you tons of other founders who are deeper in this have the same question. So I'm always glad when you ask these questions. Let's talk about the lower valuation and the higher valuation. Lower valuations are quote unquote bad for a couple of reasons. One is that if you raise a certain amount of money, let's say $1 million, let's say you raise $1 million, $1 million at a $5 million valuation, post-money valuation, is a 20% dilutive event, as in you sold 20% of your company to investors. They took 20% of your company for that $1 million. If you were able to get a higher valuation, like let's say $10 million, that same $1 million, which you'll use to do the same exact things, only represents 10% of your company. So you only sell / give away 10% of that of your company in order to get that $1 million. And that equity is important for, well, one, when you eventually sell your company, well, all that equity turns into cash for you and your employees. And yeah, for you is important, but for your employees is also important, because they own equity, and that equity is how they're going to be incentivized for future work. Now, the opposite side of things is, well, why is it good? You might be taking in a lower valuation and higher dilution by getting, by signing up for that. But it does set you up in order to show progress and momentum in your next round. There's a bit of a psychological component to this, but when an investor comes in 18 months later and they say, well, what was the last valuation that you raised at? If it's a valuation that's like what feels low, that means that everything you've done to date feels like you made tons of progress. Like, oh, they were only valued at $5 million. Well, now they're doing $1 million of revenue. like $1
Yeah.
million of revenue, that, wow, they've made tons of progress. Whereas if you actually were able to get a really, really high valuation, 20, $30 million from out the gate, as opposed to that 5, when you go talk to people at your next round, the expectation is that you are a company that would have made huge strides in progress, traction, revenue. And
Yeah.
if you don't show those numbers, and well, that momentum is not there. You're not like investors aren't like, oh my God, this is a company that keeps marching. It looks like they've barely grown into that past valuation, as in, I don't even know if they're worth the money that they were
Mm.
valued at before. And while we're all making bets on the future, like that momentum piece is really important for VCs. Also, by the way, like they also know that your employees have been compensated based on equity. And if your valuation doesn't keep going up, then the employees are like, a lot of them are thinking like, well, every year that I work here, we're supposed to be growing the value of our equity. And if you
Ooh.
can't continue growing the value of the equity, employees, early employees who are making fraction of what they could make in the open market for bigger companies are like, what am I doing here? I'm like, are we actually growing
Yeah.
the value of my equity? So
Oof.
while it can feel painful in certain markets when other people are getting much higher valuations, and we talk to founders a lot, really savvy founders who get multiple offers from venture capitalists and choose not to take the highest valuation. They choose to actually, and if you remember Emmanuel from Bubble, they
Mhm.
choose to say, I actually don't want that high of a valuation. Let's pull it down somewhere where we can show real growth with the money that
Yeah.
we're about to take in.
Yeah, the reason I was asking is because I feel like it's such a cliche that the best thing to have is like a super high valuation, which
Yeah.
maybe in some cases it is. I'm sure it is, but I think there is also strategy, like when it comes to valuation, and bigger doesn't always mean better type thing.
Yeah.
Like in Bubble's case, just like you said, they were able to use that to their advantage. And obviously, in some situations, a low valuation is probably harmful. But in other areas, like the market right now, everyone who had super high valuations in 2021, it's hard. It's really hard. And
Yeah.
no one would have been able to tell that was going to happen. So for people like Joanna, she was able to really like capitalize off of that, I guess, and show that she was able to accomplish a ton
Yeah.
with that.
Yeah. And the last thing I'll say on the topic is like, I'm giving all this advice around lower valuations are better. Higher valuations can get you stuck, but it's hard advice to follow, right? Like if you are in the middle of a fundraise and someone says a big headline number, $100 million valuation, you're thinking to yourself, wow, like there is a sexiness around being able to
Yeah.
say, we just got valued at this large number. And, you think like, oh my God, I'm not getting diluted by as much. When we exit, I could keep even more of the value. Um, and it's just not easy to follow. So like if anyone listening has made the mistake of being too highly valued, or any founders are like going through the struggle, it's not an easy decision, but these are some of the things that I think people should hear about. And in hindsight with Joanna, like some of that actually might have helped to
Yeah.
have been at a lower valuation as she went out for the latest round.
Yeah. Yeah. I think that's a good place to end. And also maybe I'll add, like, uh, you never know what's good or bad, in the moment. Like Joanna could have been really bummed that she had a lower valuation, and now she was probably jumping up and down when going out to raise her Series A. So you never know.
I'm going to end with a Chinese proverb, which is funny because I don't really speak Chinese that well. And when I was learning it, you learn these like essentially like Aesop's fables is one way to learn Chinese. And I learned I studied like 100 of them. Don't remember any of them except for one. So if there are any Chinese speaking listeners out there, what you just said is this thing like "sai wang sima yan zhi fei fu," which is a story about this guy who keeps having these things happen to him that like on paper look bad. Like he
Yes.
he had a horse run away,
My
The horse
favorite
ran
story
away.
ever.
Yeah, the horse ran away. And he's like, shoot, I lost the horse. But then the horse like attracted two other horses. And he
Yeah.
came back and he's like, well, I thought I lost a horse, but I actually gained two horses. And then later he's riding one of the new horses and he falls off and he breaks his leg. And he's like, oh my God, why is this happening to me? I broke my leg. And he's like, this is the worst thing that happened to me. But because he broke his leg, he wasn't sent to war. And then when all these people died, he stayed alive. So, 塞翁失马，焉知非福. And that's what we're talking about with lower valuations.
Damn.
If you're looking for more insights, strategies, and support around fundraising, subscribe to our weekly newsletter at fundedpod.com/newsletter. And find me on social. I'm at JayYeh, that's JayYeh, on almost every platform. I respond to newsletter replies and DMs, so hit me up. This episode was produced by Paige Randall.
Hey guys.
Thanks also to John O'Lee from Adamant.
Hey everyone.
And as always, one last thanks to our fantastic sponsor, Vanta, the leading automated security and compliance platform.